Okay, welcome everyone. Thank you for joining me this afternoon. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're going to be talking about one of my favorite subjects, leveraging technical analysis with options trading. I just want to do a quick sound check. If you guys can hear me, please type yes into the chat window. Okay, great. Looks like everyone can hear me. Like I said today, we're going to be talking about how to leverage technical analysis with options trading. And technical analysis is an extremely useful form of analysis specifically for options trading. So today what we'll do is we'll cover a few different things. We'll talk a little bit about introduction to technical analysis for those of you that are new. I want to cover why options trading is so well suited for technical analysis because of the asymmetrical risks that you have with options trading. I'll cover the few basic strategies that you should know if you're trying to utilize technical analysis and how you can leverage your views using the charting, using technical analysis, how you can utilize them with options. And then what I'm going to do is I'm going to cover the basic forms of technical analysis. And the reason I want to do this is because I've noticed that depending on the different forms of technical analysis that you use, different option strategies are useful for it. So that's really why I want to cover the basics, the different forms, and talk about why you should use different option strategies for different forms of technical analysis. And then lastly, what I do is I want to spend some time using options play to go through some ideas and showing you guys setups so that you can learn how to take what we've learned here today and leverage them into actual option strategies. Now, how many of you actually use technical analysis in your trading today? If you do, please type tech into the chat window so that I just want to get a feel for how many people use technical analysis and how many people do not. If you do not use technical analysis, please type no. Okay, so primarily almost all of you say yes. A couple of no's I see. So for those of you that are brand new, I will do a quick introduction. And then what I'll do is I'll launch into talking about how options trading is specifically useful for technical analysis. Now, I spent the last 13 years of my career talking as a market strategist to all types of traders, technical, fundamental, short-term, long-term, across multiple asset classes from FX trading to currencies to equities and derivatives. So today what I want to talk about is why I use technical analysis in my trading and as a strategist talking to different clients. So first of all, technical analysis is simply trying to forecast future prices based on historical past chart movements. So this is really simple for any of you that have ever looked at a chart. It's really the idea that history may not repeat itself, but it certainly rhymes. And what we do is we try to find these patterns to say, since based on what happened in the past, we're going to try to apply that template to say what is likely going to happen in the future. And that's the goal of technical analysis. Now, one of the reasons that it's my favorite way of analyzing the markets is really the fact that technical analysis, you can use it to analyze all tradable instruments. Because a chart is a chart, you can chart just about any single market. One of the great things about technical analysis is that once you learn how to read a chart, you can leverage that for stock trading, you can leverage that for commodities trading, you can use it to analyze things that you can't even necessarily trade that are useful in helping you determine what to trade, such as interest rates or commodity prices and indices and sectors. So you can use what you've learned here today, not just to analyze stocks, but also other markets. And that's really one of the, in my opinion, one of the downsides to fundamental analysis is that you can get really good at fundamental analysis, but it's only useful in helping you better analyze stocks. You can't really use it for analyzing other markets. So that's why being able to analyze multiple markets is really useful for your trading. And that's what we call intermarket analysis. And I'll talk a little bit about that in 1 second. So why do we use technical analysis? And the reason for it really is because we believe that markets are efficient and that price already reflects anything. Because if you're a fundamental analyst or if you're analyzing the news, you're effectively saying that all the information that's out there is not reflected in the price, that by analyzing the information, you can find some kind of edge that allows you to act on it before the rest of the market catches up. So most technical analysts do not believe that that type of information exists, or if that once that information exists, it's immediately reflected in the price. And I think that if any of you that have ever looked at a news announcement or earnings or economic news announcements, you see that the price reacts almost instantaneously to that news. There's no time to read that news, digest that news, and trade it before the reaction already happens. And that's really why we look at technical analysis, reading the charts as opposed to reading the news events or why something happened. So what is more important than why? That's an extremely important tenet of technical analysis, is that markets are not random and that all information is already reflected in the price. So there's no need to necessarily reflect why something happened. What's really more important is understanding what happened based on that result, and that will give us a template as to what is likely going to happen in the future. So with that, what I really want to cover is why technical analysis and options are such a good combination. And it really comes down to the fact that options provide you with what we call asymmetrical risk. Asymmetrical risk means the risk to reward is not symmetrical. Unlike trading a stock trade has symmetrical risk, meaning for a stock trade, if the stock goes up by $1, you make $1. If the stock goes down by $1, you lose $1. Options, it's not the same. When the stock goes up by $1, you might make 50 cents. When the stock goes down by $1, you might lose 25 cents. So that's what we call asymmetrical risk. And that's really useful when we're using options, or when we're using technical analysis, because technical analysis provides us with various directional views. And what I mean by various directional views is that depending on the form of technical analysis you use, you will have different ways to figure out where you think the stock's going to go. Now, what's really important is that options provide us with directional exposure based on our directional views, but it allows us to take that directional exposure with limited risk. Because when you buy a stock, or if you short a stock, you have the risk that the stock goes in the opposite direction that you think it's going to go in, and you have the same amount of risk as you do if it goes in the direction that you expect it to go. However, what options does is it provides you leverage when you are correct in your analysis. So if the stock goes in the favor that you expect it to, you get leverage in being able to get that exposure. However, it limits your losses when you're incorrect. And that's the key thing about any form of analysis. I don't care whether if you're a technical analysis or fundamental analysis, or if you look at some guys that use the stars to try to map out where the markets are heading. It doesn't matter what your form of analysis is that you're going to have some calls that you're right on, and you're going to have some calls that you're wrong on. And the key to any successful trader is really simple. It's limiting your losses while maximizing your upside. And how do you do that? Options provides you with a really good way to do that, because it provides you with that leverage when you're right, and then when you're wrong, it helps you limit your risk. Because we as humans are emotional. Sometimes we're wrong on a trade, and we fail to accept that, and we try to double down on the trade. And that's one of the fallacies and what causes a lot of good traders to lose money. And options is a great way to try to, in some way, prevent you from doing that, because the amount of money you pay for an option, or when you sell a credit spread or buy a debit spread, the amount of risk that you have is already limited, meaning it's already defined and it's limited. So no matter what happens, you can't lose more than that. So that's really why we want to discuss these three strategies that I want to point out. That are suitable for technical analysis. Now, what I've done is I've broken down these three strategies into two separate categories. And these two categories are defined by the various different forms of technical analysis that we can use. So there's different forms of technical analysis. Some of them provide us with what I consider as a clear entry signal and a clear target price. And I'll talk a little bit about which forms of technical analysis provides us with that. But when you are looking at technical analysis that provides you with a clear entry and a clear target, the best strategy to really use is debit spreads. Now, for those of you that are brand new to options trading, we do have webinars specifically talking about introduction to options, as well as the difference between debit versus credit spreads, and I highly recommend you to take a look at some of those webinars. The slides that I'm going to send you guys after this webinar will include the links to those webinars. So if you haven't viewed them, please take some time to learn a little bit more about debit spreads and credit spreads. But debit spreads really allow you to, is one of the most efficient ways to take a directional view when you have a clear target price. And this is really when you expect a fairly modest directional move in one direction or another. That's the best case to use debit spreads for. It's one of my favorite strategies because it allows you to take that directional view with relatively small amount of risk and a good amount of return if you are correct on that trade. And that's really why I leverage technical analysis with my options trading primarily through debit spreads. There's a second form of technical analysis where you get a clear entry signal, but you don't really have a clear target price. And I'll talk a little bit about what forms of technical analysis those are. And for those types of strategies, you generally want to use one of two different strategies. You can either buy a long call or a put. This is for when you expect a quick and fast move, and we'll also talk about which forms of technical analysis is useful for this. And then there's another form of technical analysis where you might just expect a neutral or small directional move. And for those types of trades, you want to use credit spreads. So now let's talk a little bit about what are the different forms of technical analysis and which one of these three strategies applies to each one, okay? So we're talking in the context of either trading a debit spread when we have a clear target price and we expect a directional move, or either buying a long call or a put because we expect a quick fast move, or a credit spread because we expect a neutral or small directional move. Okay, so those are the three option strategies that we'll talk about. Let's now jump into the technical analysis piece of things. And I just want to, before I get into the technical analysis piece, there are literally infinite number of ways of analyzing the charts. And what I'm going to talk about today is really just the tip of the iceberg. But what I'm going to cover is the main categories. What I'm not going to get into is all the different ways that you can do these certain things. I'll talk about the more popular ones, but there are so many different ways that you can look at chart analysis. So I'm just going to talk about the major ones so that you guys get a feel for it, but you can apply all different forms of technical analysis as long as you're doing chart analysis to the same type of effect, if you will. So when we're talking about chart analysis, it's just very straightforward. It's just reading the charts. It's basically saying, what are the charts telling me? And with this, some of the more popular ways to read a chart or figure out what's going on with the chart is simple things like support and resistance and trend lines. How many of you use support and resistance in your trading? If you do, please type yes into the chat window. If you don't, please type no, just so I get a feel for who's familiar with the concept of support and resistance. Because it should be fairly straightforward even if you haven't used support or resistance. It's really looking at what we consider as, think of it as floors and ceilings. So I have a chart here of Halliburton. As you can see, the green line represents what we call support. The red line represents what we call resistance. It's almost like a floor and ceiling, right? And these, once you see a few of them, they become much easier to read because you'll see that price tends to pool around a certain price, bounce off higher, and then hit another price, bounce lower, hit a support level, bounce higher, hit a resistance level, bounce lower, and vice versa, and so on and so on. So as you do this, all you need is two levels to draw a support line or two levels to draw a resistance line. Once you have that support and resistance line, there's two ways you can analyze this. When it hits a support, you can either say, I think this is going to bounce higher and reach that next resistance level. And when it hits that resistance level, you can say, I think it's going to bounce lower and hit that next support level. So the great thing about support and resistance lines, and there's plenty of different ways to do this, right? I really like the simple. I like the simple stuff. I like to draw horizontal support and resistance lines. Really, really simple. The best advice that I can give to you when you're using technical analysis is that the simpler it is, the easier it is to analyze, the easier it is to stick to. And what's key here is not necessarily which form of technical analysis you use. What's way more important is how consistently you apply it. Meaning, if you want to use horizontal support and resistance lines, use it every single time. If you want to use trend lines every single time. Don't mix it up, because if you're going to mix it up, you're going to get different results every single time. So find what works for you or find what you understand and stick to it. That's way more important than which one of these you actually use. So when you use support and resistance lines, you typically think of them as clear entry and clear targets, because when it hits that support level, so as you can see, when it hit that 33 level at that support level, I would expect that it would rally back up to that next resistance, which is around 42, 43. So this is what we consider clear entry and clear target. So this is a very good use of what we would typically use a debit spread for, okay? So when you're using support and resistance lines and you see a stock bounces off support and you think it's going to hit that next resistance line, debit spreads is a really good tool or really good option strategy to allow you to take that directional view with limited risk. There's another way you can use support and resistance lines, and this is where it has somewhat unclear targets. And this is, or not that it's unclear, but the fact that when it bounces off support, you don't necessarily need to say that I believe that the stock's going to rally all the way up to 42. You can just say that because it hits support that you don't think it's going to go any lower. So when it hits that 33 level again, you can say that, hey, I don't necessarily know that it's going to go all the way up to 42, but I certainly think that it's not going to go below 33. And if that's the case, you can also sell a credit spread. You can sell a put credit spread that simply will profit as long as the stock doesn't drop below 33. So those are two different ways that you can use support and resistance lines. You can also use trend lines. You can also use Fibonacci's. There's plenty of different ways that you can determine support and resistance, but I just prefer the simpler stuff. But those are the two ways that you can utilize support and resistance levels. You either think it's going to bounce off of it and going to continue going in one direction. If that's the case, use a debit spread. If you think it's hit a support level and you think it's going to bounce and not go any lower, that's when you can sell a credit spread. Okay, so those are the two primary ways that you can utilize support and resistance, or just general trend and general chart analysis to leverage options trading. Another form of chart analysis is what we consider these types of patterns or breakouts or breakdowns. These are fairly familiar for any of you that have looked at strategies, and I have a few examples that I'll show you using some real stocks that are showing up these days that are showing breakout or breakdowns. I think Apple's probably a good a recent one in people's memory. You know, beat earnings, broke out higher, just hit $1 trillion in market cap. First company to do that. So that's an example of a breakout, and then a breakdown is probably something like Netflix that broke down after earnings. So these are examples of breakouts and breakdowns. Now, the key thing about breakouts, and here's an example of breakdown where the stock traded within a range for a period of time between around $60 and $68. This was a bit of a head and shoulders pattern, but we're not going to get into that in 1 second. I'll come back to that in a little bit. And as you can see, the stock broke down and moved very severely lower very, very quickly. Same thing on the breakout. It traded within a small range between 42 and 48, and then finally broke out and then gapped higher. So breakouts and breakdowns are classified as what we consider a very clear entry price. However, what we consider a very unclear target, meaning when a stock breaks down or breaks out, we don't really have a good idea as far as where it's going to go. But these types of trades happen very, very quickly. As you can see, when you have a stock that breaks a range and breaks lower, it tends to move very quickly in one direction, or vice versa. If it breaks higher, it tends to move fairly quickly in the other direction. So for this type of strategies, it's always best to just simply buy an outright call or a put, because you're not expecting to be in that trade for very long, and you want to try to capture a big quick move in one direction or another. And the only thing I want to point out is that generally speaking, breakdowns typically happen faster than breakouts, because usually when bad news comes out, they tend to move much quicker to the downside than when good news comes out. It tends to not move as severely to the upside. So that's just a tidbit to remember, okay? But generally speaking, if you've identified the stock is breaking out of a range, either to the upside or to the downside, you don't necessarily know how far it's going to go, but you know it's going to go pretty quickly. Buy a call or a put. That's usually the best way to play that. You don't want to stay in the trade very long. As you can see, both of these trades lasted just a few days, but that's exactly when you want to just buy a call or a put, or hold it for just a few days. When the move happens, once it happens, you want to get out. breakaways and gaps is very similar to what I just talked about. It's just a different way of identifying this. Same thing, a very clear entry price, but what unclear target. So this is a breakaway where it kind of gaps above a range and then just continues to move higher. Same thing, buying a call or a put is usually the best strategy to utilize because you don't really know where it's going to go. You don't have a specific target price, and these moves tend to happen relatively quickly. When you get a gap, when a stock gaps higher and just continues to move, you usually get that move happening in just a few days. So that's why, again, buying calls and puts is usually the best strategy to utilize in this particular scenario. Next, I want to talk about chart patterns. Now, how many of you are familiar with double tops or head and shoulders or any of these types of reversal patterns that you may have seen before? If you have, just type yes into the chat window, because I know many of you have probably tried to look for these types of patterns. Now, if you're brand new, this is also something that just takes a bit of time to look at a few times. Once you've looked at them a few times, it becomes much easier to identify. So reversal patterns such as double tops or head and shoulders, these are simply patterns that we recognize and see. And this is what I mean in terms of markets rhyme, but they don't repeat themselves, because each head and shoulders looks a little different, but they look similar. Same thing with double tops, right? Double tops are simply where the stock hits a specific level, bounces off, and then hits that specific level again, and then bounces off. So what that's telling us is that, so this is an example of Gillette, which no longer trades. It hit that $60 level, bounced off, hit that 60 level, bounced off again, and then hit that 60 level again and bounced off. This is basically telling us that the stock cannot move any higher above this price, and that the fact that it increases up to that 60 level basically is telling you that it's going to reverse lower. So these are what we consider reversal patterns. And reversal patterns, again, have a clear entry price because it tells us exactly when it hits that double top or when that head and shoulders formation is completed, but it doesn't necessarily give us what we consider a clear target price. They tend to move they can move quick, they can move slow. There's no real indication as to how fast it'll move. So that's why, generally speaking, you want to use either buying a call or a put if you think that it's going to move faster. So there are certain patterns like head and shoulders where you can expect usually a quick move, but double tops, you may not have the same quick move. So depending on which type of formation you're looking at, you might want to buy a call or a put if you expect a big move, or sell a credit spread if you just simply feel that the stock's not going to continue going any higher. Because that's what really these reversal patterns are telling you, is that, as you can see, Gillette was rallying quite a bit from the 40s to the 50s and then hit that 60 level. And once it reached that double top, once it reached that same 60 level again and couldn't move any higher, this is telling us that Gillette is probably not going to go any higher. And because of that, what you can do is you can sell a credit spread. You can sell a $60 call and then maybe buy a $65 call. And that allows you to basically profit as long as Gillette stays below 60. So you don't necessarily have to think that Gillette's going to go further down, but as long as you think that it's not going to go any higher, you can still profit by selling a credit spread, okay? So these are just ways that you can utilize different forms of chart patterns and try to profit, try to have different views and profit from all of these different views that you might have. And that's really what I'm hoping to illustrate here today. Next, what I want to talk about is continuation patterns. Now, these are patterns that not everyone is probably familiar with, but any of you that have studied technical analysis will have seen these. So if you have not seen, or if you're not familiar with what a flag or a pennant or a triangle is, please type no into the chat window, because I know this is a less familiar form of technical analysis for most people. I got a few more no's this time, and that's okay, because this is starting to get into the more esoteric forms of technical analysis. But if any of you that have studied technical analysis, you're familiar with this. But continuation patterns are basically patterns that say the stock is rallied. It's kind of stopped for a little bit, but we think it's going to continue. And this is all based on market philosophy, the fact that markets cannot just continue going in a straight line higher or straight line lower, meaning markets take time to, as you can see, this stock rallied from about $28 all the way to $36, which from a percentage standpoint is a very large percentage rally. And usually after big rallies, market needs to digest a little. People need to take some profits. How that reflects in the charts is what we consider these flag or pennants, which basically look like a flag. So as you can see, it looks like the stock made a flag pole and then had a flag here and then continued going higher. This is really the fact that markets cannot just continue going higher in a straight line, that markets need to move higher, consolidate for a bit of time before they can continue. So these types of continuation patterns, what's very interesting about them is that they have very clear entry prices and they have very clear target prices, because what we can do is we can say the move that initially got us into the flag is the same amount of pricing. So as you can see, this one from about 28 to about 38, so that's a $10 move. And then after the stock consolidated for a period of time and broke out, once it broke out of that flag, that's when we expect another $10 move to the upside. So because these types of, not only do they tell us a specific target price, they also give us a rough time frame, because as you can see, it took about a month to go from 28 to 36. So we can use that also not only to estimate a target price, but also estimate roughly how long that would take. So that's one of the cool things about continuation patterns. And because of that feature, it's usually best to use debit spreads, because debit spreads allow us to take a directional view with limited amount of risk, and the fact that we have a pretty good idea as far as where it's going to go and how long it's going to take. Debit spreads is one of the best use cases of these types of continuation patterns. So if you want to learn more, you can Google continuation patterns. There's plenty of different ways that you can look at them, but they all do fairly the same thing. They're telling you that the market has rallied or sold off, and then it's the market has to digest a little, has to consolidate a little before it can continue moving higher. And I think the markets right now is a pretty good indication of a continuation pattern that we're in right now, where the S&P 500 rallied quite a bit over the last month or so, and then it's kind of just went sideways. There's been a lot of talk about trade wars. We've had some pretty bad earnings, but we also had some pretty good earnings on the other side. And the market is just kind of moving sideways and digesting before it can potentially move any higher. And I think we're starting to see that market's finding a little bit of support, but I think that continuation pattern, this flagpole, is really kind of where our market is currently in right now. So it's a very interesting way to analyze the markets, not only from a charting perspective, but also from a psychology perspective. Next, I want to move into moving averages, Bollinger Bands, or what we call chart overlays, meaning indicators that you draw on top of the chart. These are calculated indicators that you place on top of a chart. So if you're familiar with moving averages, which I'm sure many of you are, please type yes into the chat window. One of the things that I notice about these types of overlays, so moving averages, Bollinger Bands, the more familiar ones that people that use, is that I tend to see that a lot of people misuse them. And what I mean by that is because when you look at these types of strategies, Bollinger Bands and moving averages, what you have to first understand is that they do give you a very clear entry price. So if the stock moves above a moving average, that's usually used as a buy signal. If it moves below that moving average, it's a sell signal. But what it doesn't tell you is how far the stock can move, right? So a stock can go above its moving average, but that doesn't tell you if it's going to be above that moving average for a day, a week, a year, 10 years. You don't have any indication of that. Not only do you have no indication of timing, you also have no indication of target price. So that's usually why, there's one of two ways you can use this. You can expect a quick and fast move. So on Bollinger Bands, you might have a breakout and you expect a big move in one direction. You might want to buy a call or a put. But what I actually think is a better use case of moving averages and Bollinger Bands is really credit spreads. Because again, you don't have an indication of how far it'll move. You don't have an indication of timing. You just have a loose directional view. And because of that, I generally recommend most people to use credit spreads when you're looking at moving average crossovers, Bollinger Bands, because you really don't have a good view other than I think it's going to not move in one direction. So if a stock goes above its moving average, then you're pretty sure it's not going to move any lower, right? Or if it breaches that moving average, or if it breaches the upper Bollinger Band, then you might think the stock's going to reverse lower. These are all indicators that of where it's not going to go, it's not necessarily telling you where it is going to go. And for that, credit spreads are usually much better. Lastly, I want to cover chart indicators because this is probably one of the more popular strategies that people use. If you use MACD, RSI, stochastics, please type into the chat window which ones you like to use. I'm always fascinated by, as a strategist, talking to people about, what type of indicators they use. People tell me all types of crazy stuff, but MACD, RSI, stochastics, William percent R, these are the more popular ones. And the reason I want to cover and spend some time with this is the fact that I tend to find that a lot of people misuse these indicators. And what I mean by that is it's really important to understand that when you get, all of these indicators are really trying to tell you one thing. They're trying to give you overbought or oversold conditions. And there are different ways of measuring overbought or oversold. That's all they are. However, what overbought and oversold doesn't tell you is that it does give you a clear entry telling you when it's overbought or when it's oversold, but it never tells you where it's going to go. And that's a really important thing to understand when you're using these indicators, is that they simply are telling you where it's unlikely to go, but it's not really telling you where it's going to go. So I have an example of this, right? So here I have McDonald's. As you can see here in the beginning of the chart in August, it was oversold. This is telling you that it's unlikely to go any lower. That's what oversold means, right? It means that it's so extreme in one direction that it's likely going to reverse and it's unlikely going to continue going lower. But what it doesn't really tell you is how far up it's going to go. So as you can see, McDonald's was overbought here. It did end up going a little higher over, about 44 to about 46 or so. However, what overbought or what oversold really tells you that it's unlikely going to continue going any lower. Same thing here. Here in mid-September, it was overbought. As you can see, when it was overbought, what this is telling you that when it hits this 50 level and it was overbought, that's just telling you that it's unlikely to go any higher. It's not necessarily telling you that it will reverse much lower, right? So as you can see, when it was overbought, it didn't move much lower down, but it certainly didn't move any higher. Same thing here in October when it was overbought again. As you can see, when it hit 52, just because it's overbought, a lot of people use these as sell signals. People will short a stock because of that. But what I found is that that isn't usually a good use of these trades, because just because it's overbought does not necessarily mean that it's going to move significantly lower. It just means that it's not likely going to continue moving any higher. Same thing here. As you can see, when it hit overbought again, it didn't really move much lower. It just didn't go any higher. And then here again in December, this is an example where it did move lower, but that's not always the case. And because of that, because of the fact that overbought, oversold really tells you that it's unlikely to go in the opposite direction, that's why credit spreads, in my opinion, are the best way to use these indicators. These are great indicators to use, and it doesn't matter which one you use, whether you use MACD or stochastics or RSI or ADX or any of the money flow. I'm just reading the ones that you guys said that you guys use. It doesn't matter which one you use. What's more important is that you use the same one consistently. So if you're going to use RSI every single time. If you're going to use MACD every single time, and use the same settings. Don't change the 14-period RSI today and the 20-period RSI the next day and 5-period RSI the next day. If you use different indicators and different settings, you're going to get various results. If you use the same settings and the same indicators every single time, that's when you're going to get more reliability and more consistent results with your trading. So what my point is that when you get an oversold condition on one of these indicators, whichever one you use, that's a good time to consider selling a put credit spread. When you get an overbought condition, that's a good time to sell a call credit spread. And you can continue to sell these call credit spreads that will basically benefit as long as the stock doesn't go significantly higher. And that's what overbought tells you, is that it's unlikely to go significantly higher. So that's why I really want to spend a little bit of time using talking about this specific slide, because I know many of you use these chart indicators, and I want to make sure you guys use this correctly, because a lot of times I see when you get this overbought indicator, I see people buying puts, I see people buying debit spreads, I see people trying to bet that the stock's going to go lower. But what I find is that doesn't always happen. But what's more likely going to happen is that the stock's just not going to go any higher. And for that, you should consider selling credit spreads, okay? So let's now go, now that I've covered the main different forms of technical analysis and which strategies are useful, let's actually look at some setups. I want to look at some trades. Let's look at, if anyone has a specific trading setup that you're looking at or a specific stock that you're looking at, please type into the chat window. I'm happy to try to look at some stocks that you guys are looking at. But let's look at Tesla real quick. So I don't know that Tesla is a great example. As you can see, the stock jumped up yesterday on earnings to 349. It's up 16%. I don't know that this is the best one for us to look at right now because it certainly did break out of a range. But I usually don't like to trade something when it's up 16% on a day, so I'm sorry for that. But let's take a look at a different stock. Let's look at a Johnson & Johnson, okay? So Johnson & Johnson, as you can see, recently, here's what my eye tells me, is that recently it's certainly had a pretty nice run up. And I think that it certainly probably has a bit of room up to that 135 level. So here, I certainly think that 132 was a resistance level that it finally broke above. And I certainly think it's got at least some room up to about 135, 136, which is that last high back here in about May. So there's a few different ways that we can play this, right? We can look at buying a debit spread. So basically a debit spread, I think, is a great way to potentially play this, what I would consider a modest move. I wouldn't consider this a quick, fast move or anything else. I would say that if you think that the stock's going to go to 136, let's say, buying a debit spread is a very interesting way to play this because you get 110% return on this trade if you're correct, which is a very nice return. On the flip side, if let's say you're completely wrong and the stock reverses back to, let's say, 129 or 127, as you can see, you would limit your losses. So no matter what happens, even if Johnson & Johnson goes all the way down to 119, you're still limiting your losses to that $238, what you paid for that call spread. So this is really where you might want to take a look at using debit spreads, in my opinion, for trading this type of strategy. Now, I know I jumped right into options play, and for many of you that are brand new to this webinar, welcome. I hope I didn't jump too far ahead, but this platform is designed to help make your options trading a little easier because once you've done your analysis on the underlying chart, whether you're bullish or whether you're bearish, we are designed to help you provide you with starting points. So as you can see here on Johnson & Johnson, you can either buy the stock, which is what you would do if you're a stock trader. You can buy a simple call option if you're brand new to options trading, or we will always present to you the debit spread or a call vertical if you're bullish on the underlying stock. So for more advanced traders. And the reason for this is because when you're bullish on a stock and you're trying to figure out what to trade, many of you that have traded options are familiar with a page that looks like this. It's giving you a lot of different expirations and strike prices, and you can look at all of them. And what it does is it provides you with a lot of different options. But what this actually does is it mostly confuses a lot of people because you may not know where to start. You're not sure which expiration or which strike price to look at. What we want to do is prevent that. We wanted to present ideas to you before you have to pick anything. You can select I'm bullish or I'm bearish. Another way you can look at Johnson & Johnson is that if I pulled up, let's say, an RSI on this or stochastics, I bet Johnson & Johnson looks pretty overbought here. As you can see, stochastic reading of 94. This is pretty overbought. So another way that you can analyze this is you can say that, this 132 area was a resistance level back then. It's another resistance level around here, and it's overbought. So another way you can think about this is maybe Johnson & Johnson's going to reverse lower. Maybe you think it's going to go back to 127, or at least you think it's not going to go much higher. Then you might want to say, well, let me look at selling a call credit spread. So like I said, when we've identified overboughts, we might want to sell a credit spread. Let's take a look at if there's any credit spreads we can sell on Johnson & Johnson. So a short-term credit spread, especially when you're using short period RSIs or MACDs, you want to do a short period credit spread. So here, let's look at a 15-day credit spread on Johnson & Johnson. It basically says in the next 15 days, as long as it stays below 132, 133, which is, I think, a fair value, if you will, that you're going to be able to make some money. So as you can see here, if Johnson & Johnson stays at 131, or even if it goes up to 132, let's say, you make that $35 credit. And if it goes any lower, you keep that $35. And if you're completely wrong, the stock shoots much higher. Let's say it goes all the way up to 136. As you can see, the maximum amount you can lose is $65. So a little less than double of what you've received on the credit. And that's assuming that you get the worst possible fill. Let's assume you get a fill at the mid price. Your credit is $38. Your max risk is $62. That's what it would look like if you were selling your credit spread. So that's just one way of looking at it. I'm just going to try to look at as many examples as possible and provide you with some ideas. Alibaba is a relatively weak stock here. As you can see, it's sitting right above what I would consider a support resistance level to my eye. So as you can see, this 183 level was, and if we go a little further back, yeah, so 183, as you can see, was that resistance level here. It broke above it. But then as it broke above it, it came back down to test that same level around 183, bounced higher, again, bounced higher. And then here it's sitting right above that 183 level. So based on all the things here, the bearish trends, I would have more of a bearish view on this particular trade. But in my opinion, I would wait for this stock to break below that kind of 181, 180 level. And if it does, I would expect a very quick, fast move down to that 166 support level. So that's how I would look at Alibaba here. If it really breaks below that 181, 182 level, which looks like it's just about to do that, I would consider buying a put because I would expect a move down to 166 relatively quickly. So if let's say the stock moved down to 166 in the matter of, let's say, a couple of weeks, as you can see, you can make a nice 100% return on a put in just a couple of weeks if Alibaba really breaks below and goes lower. I'm not saying that this is going to do that, but that's how I would analyze this particular chart. I don't think there's necessarily a trade to make at this immediate time. The other way you can think about it is if you think 182, 183 is a support level and you think it's going to bounce higher, you can take a bullish trade. So as you can see, stochastics is reaching somewhat oversold here. So you could feel that this is going to start to turn around. So there's two ways you can play this. You can buy a debit spread to say, I think it's going to go back to up to, let's say, 198. As you can see, if it does do that, you make a nice 115% return, which is a very nice return. Conversely, what you can do is you can say that this is fairly oversold. I don't think it's going to move much lower. I don't know how much higher it's going to move, but I certainly don't think it's going to go below 182, 183. Then again, this is where you might want to sell a credit spread. So this is where you might want to sell a put credit spread because it's oversold. So let's take a look at a short-dated put spread, maybe a 15 or 20-day put spread, and let's sell like a 180 or maybe sell a 180 by the 177 and a halves. This again gives me a potential reward of 90 bucks for every contract that I sell, as long as Alibaba stays above 180. So I mean, if you feel that this is oversold and you think it's going to go bounce a little higher, I think it's pretty safe to say that I think this thing's going to stay above 180. And as long as that happens, you keep your $90 credit. And the only risk is that Alibaba moves significantly lower. If that happens, you risk up to $160 for that. But you do have a 60% probability of this call, of this credit spread being in the money. Let's take a look at SPY or the Qs. Let's look at the Qs, right? Because it's the technology ETF that everyone's looking at. And this is really what I was referring to in terms of, I feel that the markets are kind of just in a sideways consolidation market right now. As you can see, we've had a pretty big rally from April to now, right? So we've had close to from 150 to 155 to about 182. So a decent percentage. We're talking about a little over 15% move in a matter of 3 months. So that's, or 4 months, that's a pretty big move. And I feel that the markets are kind of digesting a little, moving sideways before it can continue moving higher. So for this particular case, what's really interesting is that if you want to look at a trend line, as you can see, this is kind of a pretty good trend line that it's kind of just hitting that support level and maybe starting to catch that move higher. So when we referred back to our talking about support and resistance, we remember that support and resistance, debit spreads, generally speaking, are a good way to play this if you have a specific target, or you can always sell a credit spread if you simply just think that the stock's not going to move any lower. So I think this is a pretty good setup for comparing a debit to a credit spread, right? So let's say I want to sell a credit spread. I'm bullish on it, so I'm going to sell a short put vertical. Let's look at a shorter dated one, and let's go a little further out. Let's say we sell the 176 sell the 178.5, so $1 below the current price, and then we'll buy the 176.5. Maybe we'll go a little wider. However you want to set this up, there's lots of different ways to play this. So if the Qs move up modestly, let's say it moves up to 180. As you can see here, you're better off selling this credit spread versus buying that debit spread. And that's really one of the key things about this platform is we want to build a platform that was easy for you to compare one strategy to another, not just look at a chain and have to pick something. We wanted to allow you to compare different strategies. That's one of the things that you couldn't do through an option chain is you can't compare buying a call to a call spread or buying a debit spread to a credit spread. But these are the types of things that you typically need to do before you can decide what should I trade, right? So if you're looking at the Qs and you think that 180, 175 is a good support level, you think it's going to bounce higher, you're not sure how far it's going to go, then you might want to trade a credit spread. But if you're pretty confident that this thing's going to go back above that high and it's going to go to 186, 187, then you might want to buy that debit spread, because as you can see here, you're going to make a significantly higher return on the debit spread than you are on the credit spread. Here you're only making $79. Here you're making $393. So that's really why, as you can see, this risk is relatively similar, and you can even normalize that by saying, let's say I'm willing to risk $1,500 on this trade. So here, I'm willing to risk $1,500 on this trade. So both trades risk you roughly $1,500. And then let's go back to this trade. As you can see, if the stock goes up to 187, here I'm only making $475. Here I'm making $1,500, more than 3 times the amount that I'm making on the credit spread while risking the same amount of money. That's really where the power of options play allow you to compare different strategies side by side and say, if I think the stock's going to go higher, what's my best strategy? If I think the stock's going to stay where it is or it's just stay marginally where it is, which strategy is best? It quickly allows you to compare, hey, the credit spread gives me a $400 profit versus the debit spread loses $1,200. So if that's the case, I'm certainly not going to trade the debit spread. I'm going to trade the credit spread. So this allows you to set up all different types of strategies on yourself and be able to take a look at this. I don't have a lot of time to go through all of the symbols that you guys put out, but I'm certainly going to try to look at as many as I possibly can. Facebook, not much to say here other than the fact that it's certainly gap lower. This is usually where we would typically buy puts. So as you can see, when we're talking about breakouts and breakdowns, or what I consider gaps, so Facebook basically did the exact opposite of this breakaway gap. It broke down. And usually what we would typically do is we would buy puts once that gap lower, because we would expect a quick move lower, which is kind of what we're seeing here, right? So it gapped down to about 178, 177. Now it's trading at 176. Certainly recovered a little bit. So this is depending on your views on Facebook, right? Because it certainly is very oversold. So I would expect possibly a bounce higher, but that's it's hard to say, right? I'm not here to necessarily provide you with the technical analysis. I'm here to provide you with, regardless of what your views are, what's the best way to play this. So there's 2 ways you can think about this. You can either think that Facebook is going to bounce higher. If that's the case, the good thing about these breakaways is that it gives you a pretty good idea as far as where it can go up to. And I think Netflix was probably a good example of this, right? Netflix gap lower on earnings, and then just kind of continue to move lower. I think Facebook will follow a similar template, gaps lower, and will probably trade lower down to 161, 150 possibly to the downside. So I would look at buying a put vertical, because you have pretty clear targets here, right? So, Facebook was near this 159 level just a few months ago. So I think 159 is a conservative target here. So you can say that if I buy this put debit spread, then and I have a target of 159, you can make almost a 200% return on Facebook if it does move lower. So this is how you can utilize our platform, regardless of what your technical analysis skills are or what form of technical analysis you use. I want to show you the flexibility that our platform can use for all different types of trading. So if, let's say instead that you think Facebook is oversold, you think it's going to bounce higher, you think it's going to make a quick move back up to 195, right? So let's say you think it's going to go to 195. You think it's going to happen in a very short period of time. Use our P&L simulator. It does all the calculations for you. So what happens if you think it's going to bounce really high to 195 in a short period of time? It's telling you you should buy the call, because that will give you 183% return if Facebook does bounce higher. And I know many of you are very bullish on Facebook and you do think it's going to bounce higher. Then utilize our tool to help you gain the maximum amount of profit while minimizing your losses, because that's the key here. No one has a crystal ball. No one will know where the markets are always going to be headed. So it's really important that you get the leverage when you're correct by using options, because the options give you that leverage. But at the same time, limiting your risk when you're wrong, because we could always be wrong at some times. And when we're wrong, we want to make sure that we don't lose our shirts and we don't blow up our entire accounts, that we don't have enough money to continue trading. And that's what options helps you do. Okay. So I want to make sure everyone understands that. So that is really, the bulk of what I wanted to show you guys here today. What I will do at this point is I will open this up for Q&A. I'll try to go through a few more examples for stocks that people have asked me to look at least the ones that I recognize. So let's take a look at Micron. I'm just pulling up some of these stocks as I go along. So please, if you have any questions, please type them into the chat window. I'm happy to answer as many questions as possible. Micron, very strong stock, score of 9. As you can see, the trend quality has certainly deteriorated over the last couple of weeks. 1 month and 6 month trend has turned bearish. So I certainly think this 52 level is a support level that's sitting right around. As you can see, it bounced a little higher today. So maybe, and certainly stochastics is quite oversold here. So I don't think it's crazy for someone to say that this is a relatively strong stock in a strong sector that's just gotten beaten up because, we've had poor earnings out of Netflix, poor earnings out of a few different tech stocks. Facebook, Netflix certainly did not help. But, maybe you think it's going to turn around because it's not related to the same stuff that Microsoft and Netflix is on. We're talking about a computing stock. So maybe you think it's going to be a bullish trade, and you think it's going to move up to at least 58, I think, is a conservative target here, which is the high it was just at a few days ago. So if you think it's going to go to 58, as you can see, buying this debit spread gives you a very nice 100% return if you're correct on the trade. And I think that would be probably one of the better ways to play this particular trade, is using a debit spread on something like this. So I'll try to answer as many questions as I have time for here. So can you label credit spreads column? Sure. So that's a great question. So that's one of the things that I think, I talk about the term credit spread, but credit spread in itself is not a strategy. Credit spread is a type of strategy. So I do recommend that if you're not familiar with credit spreads, that view our recording of our webinar specifically on that, on how to construct a webinar and how to construct a credit spread and which ones are the credit spreads. So what I will do is I will send in the slides that I send you, there is one of the slides is a link to our webinar recordings. I highly recommend you to take some time and view those webinar recordings in order to utilize or better understand how to utilize credit spreads in your trading. Why buy the call? It's red in 76 and 95 0. Great question. So Susan, so I think Susan's asking is, why would you buy this call when it's 75? So I want to point out, this option display score is telling you what the risk to reward of a trade is. Now, the risk reward on this particular trade doesn't look spectacular. However, as you can see, that doesn't necessarily mean that you can't trade it, because in the example that I provided, if Micron hits $58 in a relatively short period of time, as you can see, you're still making a 72% return. So just because it's a low score doesn't mean you can't make any money. It just means that you may not make as much money, and it's just telling you that the risk reward is not great. So that's really where it depends on how experienced you are as an options trader. I certainly would not recommend a beginner to go outright and buy something with a relatively low options play score like 75. But if you're experienced and you understand the risks that come with it and you're willing to accept those risks, that's okay. It doesn't, just because it has a low score doesn't mean you can't trade it. It just means that you may not make as much money. But if you see an opportunity and you feel that the opportunity is there, you can certainly use this for your trading. I know I have a lot of questions here. I'll try to get to as many as I can. Joe's asking, your Amazon pick of the day was great. I paper traded it. Can you talk about how you arrived at it? That's a great question, and I think this is worth exploring. Amazon, which was our trade idea today, the question was, how do we arrive at it? And the answer really was twofold. We wanted to look at, we always apply what we consider top-down approach, meaning we never look at individual stocks. We never try to pick individual stocks. We always look at the market, and then we look at sectors first. So we wanted to look at what sectors, what is the market doing? And as you can see, the 1 month and 6 month trends were bullish for the market. So we wanted to look for some bullish ideas. And when we look for bullish ideas, we want to first focus on what sectors are strong, what sectors are weak. That's when we pulled up the consumer discretionary and technology, because that's really the two sectors that you want to look at. So what we looked at was that technology looked like it was bouncing higher off of the support level. So, and that's really when we started looking at the individual stocks. And that's how we found Amazon was one of our scans, because Amazon was as you can see, the 6 month trend was bullish, but the 1 month trend turned neutral, which is usually a good indication. And the fact that Amazon was sitting right above a support level, that was one of the reasons why we chose it, was because short-term trends turn neutral, which is usually always a good opportunity as long as the 6 month trend was bullish, and it was right against that support level. So we felt that there was a pretty good chance that it was going to bounce higher. And that's why we picked Amazon, because we looked at the sector. The sector looked like it was doing the same thing. As you can see, the sector was just bouncing off of the support level, and we saw Amazon was doing the same thing, and it was, just everything was lining up. The sector, the stock, everything was bouncing off the support. Those were the things that we looked at when we picked Amazon. So great question as to why we picked that. Carl is asking, on Johnson & Johnson, the debit spread cost versus a straight call option is only $19. Why isn't a straight call better? Well, it's the reason the straight call is not better is because it costs you more money, which means that the break-even price is higher, which means that, and the fact that, so for example, one is 238 and one's 257. So as you can see, if the stock goes in one direction, let's say it goes up to 130, what did we say, 136? The reason that you get a higher options play score is because the fact that this trade costs that $19 more, you're going to get a significantly lower return, a 95% return versus 110% return. So that's really why you get, not only do you get a higher return when you're right, but you also have smaller losses when you're wrong. So if, let's say, Johnson & Johnson doesn't move in the direction you expect it to, in one trade you get a $257 loss, the other one you get a $238 loss. So not only when you're wrong do you lose less money, but when you're right, you're going to make more money. That's why this has the higher options play score, and that's why you would trade that versus just buying a call. Can you speak in terms of the timeframes on your chart? So we only use daily charts, and there's a reason for this, is because anything less than daily charts, meaning if you're using minute charts, is really not suitable for options trading. Options trading is not something that you would day trade. Options is something that you would typically, at the very least, swing trade, and that's why we only look at daily charts. We don't think it's a good idea to look at minute charts if you're trading options. So we always use daily charts. Great question. Are you considering getting real-time data feed? Really good question. That is something we are actually in the process of working out, and we expect to have it done by the end of the month, where we're going to be able to offer real-time data feeds for people. There will be a fee for that. However, we're excited to offer real-time feeds for people very, very soon, and that will be coming soon. When taking the cursor to support and resistance line, the gray box, Oh, so the gray, a lot of people ask us this question, and the 00 means nothing, but the 64 bars just simply refers to how long that support and resistance line has been drawn for. So as you can see here, it's been there for 49 days, here it's been for 64 days, so that's all it tells you. 00 is just telling you because it's a horizontal line, that's why it's 0, because if you drew a trend line, that's when it would tell you how far the stock has moved up or down, but because it's horizontal, it will always be 0. Can you go through an example with Bollinger Bands and Keltner channels? So sure, I can do that, but let's take a look at Johnson & Johnson. I actually think it's probably a good example of this. So a few different ways that you can read Bollinger Bands, right? So a lot of people will use the upper Bollinger Band as a reversal, so meaning when it hits that upper Bollinger Band, you feel that it's going to reverse lower. That's how it was originally designed for. However, what I see more and more is that when a stock really breaks above that Bollinger Band and is able to close above that Bollinger Band for multiple days, that's usually more of a bullish pattern than anything else. So depending on how you want to use your Bollinger Bands. So here, if you see that the Bollinger Band breaks above and then closes back below, that's usually an indication that the stock's not going to go any higher. That's where I would consider selling a credit spread. But as you can see here, the Bollinger Band broke above its upper band, and the second day it actually continues to close above that Bollinger Band. That's usually a pretty good bullish signal. For that, you usually see a very quick move in that direction. So for that, I would typically use buying a call or perhaps a call spread, but because I don't really have a good target price for it, and I think usually it's a quick move, I would usually just outright buy a call in my opinion. Is it the green arrow and red arrow in the middle panel? So the green arrow and the red arrow is just telling you that when the buy signal was generated. So I think Amazon just lost the buy signal because we just processed today's signals. So yesterday Amazon was a trade idea, so there was a green arrow here. That's just telling you that Amazon was a trade idea for the day, and the green arrow tells you that it was a buy signal for that day. Can you talk about your numbering system, yellow band? If you're referring to the options play score, the coloring system is really simple. It's red, it means poor risk reward, yellow means good risk reward, green means good risk reward. That's all it is. Really easy to remember, red, yellow, green, designed to help make this as easy as possible. There's a lot of questions here. I'll try to get to as many as I can. Do strangles or iron condors show up in options play? Absolutely. So one of the things that I was just showing you guys here today is you click on modify, use the strategy constructor. That allows you to construct all different types of strategies. So if you want to look at more complex strategies like condors and butterflies, you certainly can. My suggestion to you is that if you want to trade butterflies and condors, don't think of them as one strategy. Think of them as two separate strategies. All butterflies and condors are basically debit spreads and credit spreads put together. And because unless you expect the stock just to stay exactly where it is and not move, which I can't think of any form of technical analysis that would tell me that, that's really the only time you would use a butterfly or a condor. Otherwise, you should leg into a butterfly or a condor based on where you think the stock's going to go. So if you think the stock's not going to move any higher, sell that call credit spread. If you think it's not going to go any lower, sell that put credit spread. And those two combined will make an iron condor, but you don't enter that iron condor at the same time because you can only expect the stock to either move lower or move higher. You can't expect it to just not move. Or at least I don't know of any form of technical analysis that tells you a stock's going to stay where it is and not move. So keep that in mind. If you want to trade iron condors and butterflies, think of them as two separate strategies because that will probably help you gain better trading and better returns, in my opinion, if you're trying to use iron condors. Jerry's asking, how is work to get credit spreads working thus far? Not sure what you mean by that question, Jerry. If you can rephrase that question, happy to try to answer your question. Charles is asking, how many days do you use in your moving average? Great question. So we primarily use 3 moving averages, 20-day, 50-day, and 200-day. like I said, it doesn't matter which one you use. It's really about how consistently you use it. And how I gain consistency and how I use my moving averages is because I actually don't look at the moving averages. Our 1 month and 6 month trend indicator does the analysis for me. It looks at the 20-day, the 50-day, and the 200-day. And based on those three moving averages, gives me an indication of whether bullish, bearish, or neutral. And that's why I talk to people. Don't worry about which moving average you use. Don't worry about which indicator you use or which period you use. Just make sure that you stick to whichever one you choose. Pick one that you're comfortable with. Pick one that fits your time frame for your trading, and stick to it. That's the most important thing. So how I stick to it is by looking at the 1 month and 6 month trend, because I'm applying the same moving averages every single day. It's never changing because the 1 month and 6 month trend uses the same indicators every single day. So I can't stress that enough. All of these forms of technical analysis that I'm showing you guys here today, they're different ways of applying the same different methodology. So it doesn't matter which one you use, it's all about how consistently you use it. If you want to use leverage technical analysis in your trading, make sure you stick to one or two ones that you're familiar with, that you're comfortable with, and stick to it. That's the most important piece. And I hope you guys can learn something from that. Do you hold the stock through earnings or do you exit the day before? Great question. That depends on what your views are, because if you're trying to make an earnings trade, then you certainly would hold through that earnings. So if you're placing a trade without considering earnings and it's approaching earnings now, then I would say you might want to get out. But most people trade specifically for earnings. So if you're trading specifically for earnings, you want to hold it through. But if you made a trade and it's working out, and I think Facebook's probably a good example of this, right? We had a bullish view on Facebook going into earnings. We were up about 70% on that debit spread. And we simply felt that it didn't quite reach our target price, and we felt that Facebook was going to be strong going into earnings, and that did not happen. And we were completely wrong on that. We basically lost all of our money on that trade. But that's okay. That's one of the things about trading, is that you can't be right all the time, and when you're wrong, you want to make sure you limit your risk. And that's why we use options, because no matter how far Facebook goes down, we were only limited to the amount of money that we paid for that debit spread. So it was a tough lesson to learn going into earnings, but it really depends on why you got into that trade. So you should ask yourself that question before earnings even comes up: did you get into this trade because of earnings, or did you not get into this trade because of earnings? That helps you determine should you hold it through earnings. What is the time period you look for in the chart to identify the trend, 1 month and 6 month? So that's proprietary to us. This is a proprietary indicator that we developed. We look at specific forms of moving averages. We use a triple moving average. We use different moving averages in different periods to do that. So, but it's designed to give you an idea as far as the 1 month and 6 month trend. But we do not disclose which moving averages we use for that. Joe's asking, I trade for income. So if you have a stock tagged as bearish, would you not sell a put against it? I don't know that you'd sell a put against a stock that was bearish, because selling a put is a bullish strategy. You would typically sell a put on a trade that you were bullish on, Joe. So I'm not sure why you would sell a put on a stock that you were bearish. I certainly wouldn't recommend it. David, that is correct. Susan, you offer entry strategies. Do you also offer exit strategies? Great question, Susan. So I highly recommend you to view our specific webinars on trading credit spreads and debit spreads, because I talk specifically about exit strategies for both, because exit strategies aren't based, generally speaking, on the trade itself. They're based on money management techniques. And so it depends on when you enter those trades, how much you've paid for those trades, to determine when you should exit one of these trades. So I highly recommend, if you right now we're talking about entries, if you want to learn more about what are the money management techniques you should use for credit spreads, debit spreads, and buying calls and puts, please view our webinar specifically on that, because we do cover those in detail on those. So if you're unfamiliar with those strategies, view the debit versus credit ones. If you have a specific one in mind, just view the how to trade debit spreads or how to trade credit spreads on more details on that. Carl, but you can leg in. I'm guessing you're referring to that iron condor thing I'm talking about, and absolutely yes, you can. That's my whole point, is don't trade an iron condor as a strategy. Leg into both sides separately. Justin, in your question about pricing for options play, please send me an email at info@optionsplay.com. I'm happy to look into your account and give you the pricing for your specific account. Jerry's asking, referring credit spread question. Perhaps you are not aware that the platform has not been working to provide viable credit spread alternatives. I'm not sure what you mean by that, but let's take a look at Amazon, right? So let's say on Amazon, maybe you don't agree with us. Maybe you don't think it's going to move significantly higher, but maybe you think it's not going to go below the 1760 support level, which we've identified here. So let's remove these Bollinger Bands real quick. So let's say we see that Amazon hit that support level, bounce a little higher. Maybe you don't think it's going to go much higher, but you certainly don't think it's going to go below 1760. So let's set up a credit spread on Amazon. So how you do that, you click on Modify, Strategy Constructor. Because we're bullish here, we're going to sell the short put vertical. So let's take a look at a short put vertical on Amazon. So let's look at a shorter dated one, let's say a 22-day one, right? Let's take a look at going a little wider, and let's go down to, let's say, I'm going to sell the 17. Let's see, what would I sell? Let's say I sold the 1760s and I bought the 1740s. So this is a credit spread that I've sold on Amazon, or I'm sorry, I don't know why I'm looking at the 1700s. I meant the 1800s. Let's see. So regardless of which strikes you choose and which expirations you choose, to set up a credit spread, Jerry, it does work. You just have to make sure you select the correct one. So short put vertical would be the one that you would select for a bullish trade. And then if you're a bearish trade, you just click on bearish and then a short call vertical. Can you recommend a book explaining technical analysis? I actually recommend, instead of a book, stock charts is a great starting point for most people. I actually do a lot of work with stock charts. A lot of the things that we've learned myself comes from stockcharts.com. They have what's called a chart school. I highly recommend, for those of you that are learning about technical analysis, to start here. It covers a lot of the basics, and it goes into in-depth how to calculate everything. And the best part about this is that you can actually utilize the tool with what you've learned. So stock charts will actually do that charting. So not only do you learn it, you can actually have the application of it instantly. So I highly recommend that. Sometimes reading a book is one thing, but once you actually get to the charts, it's a whole nother thing. Stock chart really does a good job of merging the two. Tom, thank you so much. I really appreciate it. Again, if any of you guys have any feedback on these webinars, this is the second time I've done one of these technical analysis ones. I really hope you guys find this useful. We do this purely for education for you guys, not only to teach you about technical analysis, but more importantly, making sure that you're leveraging the options piece of this correctly. And I know that I went through a lot of things here today, and I don't expect everyone to memorize everything. So please make sure that you watch the recording and also take a chance to look at the slides and view some of the previous webinars if you're unfamiliar with some of the terms like credit spreads or debit spreads, because it's really, options is is an education that's going to take some time. It's not something you learn from one single webinar. It's a series of webinars, and that's why we've built up, a pretty good playlist of about 15 different webinars that you can view, learning all different types of strategies, from the very basics for those that are brand new to more advanced topics like credit spreads and debit spreads, and then really helping you merge that all together with webinars like technical analysis, so that you can learn not just the options piece, but also the analysis piece to figure out when to buy, when to sell. So that's really kind of why we do these webinars. And if you guys have any feedback, please send them to info@optionsplay.com. I'm happy to answer as many questions as I can. Do you have recommendations to play options or index? Yeah, so Sean, that's one of the great things about technical analysis, is because you can apply what you learn with if you're going to chart school and you're learning about technical analysis and different forms of analysis, you can apply it to anything. It's not just stocks or ETFs or indices, or you can apply them to commodities and FX and all different types of things. That's why I love technical analysis, because I take what I've learned and I apply it to all different forms of trading. And sometimes I don't necessarily trade those indices, and I may not trade commodities, but they certainly have effects on what we trade in stocks. So if I'm trading an energy stock, it's really good for me to understand what's going on with oil prices. If I'm trading financials, it's really good for me to understand what's going on with interest rates. And that's what the beauty of technical analysis is, that I can analyze interest rates, I can analyze oil prices. Even though I have no really good fundamental understanding of those markets, I have a pretty good idea of what's currently going on. And that's one of the beauties of the technical analysis. How are the probabilities calculated? So that's pretty standard. Probabilities are calculated based on implied volatility. We create a probability density function based on those implied volatilities, and that allows us to basically create a tree of what is the probability of the stock hitting each price in the future, and that's how we calculate all our probabilities. And that's also the same thing of how we calculate the Greeks. It's using that same implied volatility to calculate Greeks. So we certainly use the Greeks, but we don't talk about them in the Greek terms, because a lot of times we talk about delta, theta, vega. It confuses people. It scares people off. So what we do here is we give you this nice, pretty price slider. So as you can see, if you think the stock's going to go higher, instead of saying that you have a 50 delta and then you have to calculate all of that, we do all of that work for you, and you just get the output. So you don't have to worry about the Greeks and think about how to use them. We calculate theta, vega, and delta for you using these sliders. And you don't even have to know that we're using those Greek terms, because all you really care about is how much money do I make or how much money do I lose. And that's really why we created this P&L simulator, because we wanted to give you the functionality of the Greeks, but we didn't want you to have to do that calculation yourself. So use the P&L simulator. That's really where the Greeks are, but we want to present it to you in an easy to understand format. And that's the philosophy that we have here with Options Play, is we want to make options as easy as possible for you to understand. In J&J, could you leg in? I'm not sure what you would leg into for J&J. If you have if you can tell me what you would leg into that, I'm certainly open to trying to help you. If a trade goes against you, do you exit the entire position, or do you get rid of the losing leg and hold on to the winning leg? It's usually the other way around. If you're trading a spread and you want to leg out, you would usually close the winning leg and hope that the losing leg comes back. Because if you got rid of the losing leg, the winning leg, I guess it depends on whether it's a credit or a debit spread. So that's a very specific question. If you have a specific example of that, why don't you shoot me an email at info@optionsplay.com. I'm happy to look into that specific trade that you're looking at, because it really depends on the scenario, and there's too many to kind of just assume at the moment. Stock Charts is offering ChartCon next week. Excellent webinars. Absolutely. I think Stock Charts is one of the best resources for free on technical analysis on the web. So I highly recommend, for those of you that are interested in learning more about technical analysis, to take a look at Stock Charts. Jose, thank you so much. Ivan, thank you so much. Richard, thank you so much. I really appreciate this. Joe, thank you so much. Keith as well, same thing. I really hope that you guys learned something. Bob, same thing. Joe, can I catch all of your webinars? Yes, absolutely. So that's what I was saying. In the slides that I'll send you, the first page will have a copy of our links. So you can click on the webinar recordings link, and that will take you to a recording of all of our webinars. And we keep those up to date. So when we do the same topic over again, we just give you the latest one. So you don't have to go through pages and pages. We keep a playlist of our most recent ones so that you can always get a list of all of our most recent recordings. Carl, buy one Johnson & Johnson leg, and then when it goes up, sell the higher leg. Sure, absolutely. It's not traditional that people would do that, but absolutely. If you really have a very keen view on where the stock's going to go, absolutely. You can buy this call when you think it's going to go higher, and then when it kind of reaches that 136 level, then sell that call. You absolutely can. But the goal of entering a debit spread as a debit is to limit the amount of capital that you outlay up front. Because again, we don't have a crystal ball. You could enter this long leg, and then the stock drops. And if that happens, then you're risking more money than you would if you had traded just the debit spread as a whole strategy. So you can, if you have a very keen understanding of where you think the stock's going to go, but the goal of this is to, again, overall reduce your risk. Raymond, thank you so much. Lauren, thank you so much. I really appreciate the kind words here. Joe's asking, how do you feel about rolling? Rephrase, how do you feel about rolling when a trade goes against you? Great question. How do I feel like, what do I feel about rolling when the trade goes against you? Generally speaking, rolling is a strategy when the trade is going in your favor. It's generally not a good idea to roll when it's going against you because, so my only point on rolling it when it goes against you is that's kind of like doubling down on a losing trade. And that's almost never a good idea. So I would say that you would have to think about both trades independently of each other. Don't think about the fact that you've lost money. Think about, would I enter a brand new trade right now? If the answer is yes, I would enter a brand new trade right now, then you could roll a losing trade, but you should always ask those two questions independently of each other. Would I enter the trade right now if I wasn't in a losing trade? If you were, then sure, roll it into it. But if you wouldn't, I would not recommend rolling. Again, rolling is usually reserved for when you have a trade that's working in your favor, but you're running out of time, so you got to roll it to a further expiration. That's usually how you use a roll. So the quotes and charts are end of day data? No, so the charts update during the day. So throughout the day, you will see the intraday chart. They're not end of day. For opening up a new margin account, any insights on if I should go with Interactive Brokers or Tastyworks? So that's where we are fairly broker agnostic. We don't have a specific broker that we recommend. We really want to work with all brokers here. As far as Interactive Brokers versus Tastyworks, there are two very, very different brokerage firms, in my opinion. One providing very low cost access to all different markets with minimal customer service. The other one providing very high touch service, in my opinion, at relatively higher commission rates. So it really depends on what you're looking for. If you need help, if you want customer service, go with Tastyworks. If you just want bare bones, but you want access to as many markets as possible, as cheaply as possible, Interactive Brokers certainly is probably the better way to go. Dan, absolutely. Thank you so much. I really appreciate the kind words. Irina, thank you so much. Any other questions from anyone? I hope I didn't forget any questions, but this is probably the most amount of questions I've ever had on a webinar, which is usually good. It means people are engaged, but I hope I didn't forget any questions. I want to thank everyone for taking the time out this afternoon. The recording will go out in about half an hour. So that with the slides, again, for those of you that are looking to learn, make sure that you take a look at that slides. Susan, our email address is info@optionsplay.com. If you have any questions, feel free to email me there. Irina, Theo trade? I'm not sure what the question is there. Joe, please send me an email at info@optionsplay.com. I'll look into your account and provide you with your pricing. Susan, it depends on which brokerage firm you're at. So please just shoot me an email. I'm happy to talk to you about that. Thank you so much for all the kind words from everyone. Like I said, again, the email will go out in about half an hour with those slides. Make sure you take a look at those. I hope you guys find this helpful, and I will see you guys next week. Next Thursday, we'll have another webinar, and I hope everyone has a great afternoon. If you have any questions, again, please send us a question at info@optionsplay.com. I hope everyone has a great afternoon, and thank you so much for joining.